Howdy, y'all. Welcome to Liberty Call. Today is Tuesday, October 3rd, 2023. Hope everybody's had a fantastical day out there in the interwebs. I am Raymond Dahlman, your humble host. Got my Texans gear on today. They've, come back and have a 2-2 record. Who can believe it? Didn't talk about them yesterday because I was bragging about the Astros, but they look pretty good. That new quarterback they've got. I haven't watched any of the games, to be honest, but because it's still baseball season and those games seem to conflict, unfortunately. But they look... was it CJ Stroud? I think his name is. Looks pretty solid. Plus, my fantasy team is kicking butt. I did lose this last weekend, but I am 3-1 and smoking the rest of the league. So, anyways, well, Todd, if you're watching that, well, you could agree. I'm in third place right now, but still doing really good. Anyways, all right. Well, if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me one big favor, press that like button. Give me some thumbs up, some like, share, subscribes, follows. Press that notification bell so you know when I go live, and let's go ahead and get into the numbers. Dow Jones was down 1.29% today, 430 points. It was down as much as, I think, over 500 at one point. Closed at 33,002. S&P 500 down 1 1/3, closed at 4231. Nasdaq down 1.87, closed at 13,059. The VIX was up 12.44% today. It is at 1980. Let me pause here. And if for those who are not, if it's your first time watching, the VIX is the volatility indicator. It's tied to the S&P 500. And when it's below 20, I view that as, it's your safe zone. It's kind of your green light. When it's between 20 and 30, that's your yellow light. Proceed with caution. Now when it's, if it's over 30, that's your red light. Stop, look both ways. If you feel it's safe, go on your own accord, but, you're on your own at that point. All right, back to it. Canada was down 0.81%. Brazil was down 1.53%. And Mexico was down 1.69%. Over in Western Europe, Germany was down 1.06%. The UK was down 0.54%. France was down 1.01%. The Netherlands down 0.62%. Spain down 1.65%. Italy down 1.32%. Switzerland down 0.92%. And Portugal down 2.74%. Russian exchange is both green. MOEX up 0.37, RTSI up 0.16. And let's see here. The overnights, the Nikkei in Japan was down 1.83%. Australia down 1.28%. New Zealand down 0.21%. Chinese markets are still closed except for the, the Hang Seng appears to be open. And it was down 3%. And I think that's it. So, yep, that's it as far as the Asian markets. And because we talked about it yesterday, there's some sort of Asian holiday that they celebrate. And I think they're going to be closed for most of this week if memory serves. All righty, well, let's go ahead and hop into the market recap. Dow sheds nearly 500 points as yields jump. S&P and Nasdaq also tumble. All right. Today, Tuesday, the S&P 500 experienced a decline driven by unexpected strength in the labor market, intensifying concerns of higher interest rates by the Federal Reserve. The U.S. Labor Department's job openings and labor turnover survey report for August revealed a surprising increase in job openings to approximately 9.6 million, surpassing expectations for a decline to 8.8 million. This unexpected sign of a tight labor market heightened fears of a potential Fed rate hike later this year, leading to the 10-year and 30-year Treasury yields reaching their highest levels since 2007. Despite a tech rebound on the previous day, tech stocks faced a renewed selling pressure, particularly from major players like Microsoft and Meta Platforms. Meta faced additional challenges as reports surfaced suggesting it was considering a $14 monthly fee for users wanting an ad-free version of Facebook or Instagram. This decision follows a July European court ruling requiring Meta to obtain user consent before displaying personalized ads, posing a threat to the company's advertising revenue. McCormick and Company witnessed an over 8% decline despite an upward revision to its full-year earnings guidance. While McCormick improved its outlook, Q3 revenue fell slightly short of analyst estimates. The company cited special charges related to organizational actions, expecting them to reduce earnings per share by 16 cents in 2023. However, excluding these charges, adjusted EPS was projected to be between $2.62 and $2.67 per share. Energy stocks faced a modest dip of less than 1%, influenced by a rebound in oil prices ahead of the OPEC Plus meeting. Notable decliners in the energy sector included Valero, Phillips 66, and Marathon Petroleum. RBC noted that despite a nearly 9% increase in prices since August, no major production policy shift was anticipated in the upcoming OPEC Plus meeting. All right, so everybody's getting beat up like Rocky this week, so not good. Plus, I mean, we had another bear sighting over the weekend. So that's 2 bear sightings here at this residence since Chairman Powell spoke several weeks ago. If you do recall, there was a bear sighting mere moments after he finished his talk, and the market reacted poorly. And then we had another bear sighting on Saturday or Sunday, I forget which. And the market's been down again, even more at a faster pace this week again. So I don't know. The bears wandering around out here in the woods might be affecting the stock market. I can't say for sure. All right. Next article up here from Zero Hedge titled Government Shutdown Averted, but is that a good thing? It's written by Lance Roberts via realinvestmentadvice.com. Get my notes up here. All right. The recent government shutdown, a consequence of ongoing fiscal irresponsibility in Washington, has prompted concerns about economic and market impacts. While government shutdowns and debt ceiling debates are not new, the current trend of stopgap measures and lack of a comprehensive budget is noteworthy. Since 2008, the government has operated without a budget, relying on continuing resolutions that essentially maintain previous spending levels and compound spending annually by about around 8%. This has led to a significant increase in debt issuance and a growing deficit. Before 2008, revenues exceeded the running growth trend of public debt, but post-2008, the deficit has been on an accelerating trajectory. The recent stopgap measure, while preventing an immediate government shutdown, does not address the fundamental issue of fiscal responsibility. The government has been functioning without a clear budgetary framework, relying on temporary measures that perpetuate existing spending levels. Government shutdowns primarily impact discretionary spending involving government employment, national parks, and monuments. Mandatory spending, including Social Security, welfare, and interest on the debt, continues unaffected. The majority of government spending is tied to the social welfare system and debt interest. I mean, seriously, if you laid off, how many federal employees are there right now? Probably 3-5 million. If you fired all of them today, I mean, will we really notice for like 6 months? I would. I mean, other than the bums standing around with their hands out because they don't know how to get real jobs. But anyways. While the government shutdown may have a minor negative impact on economic growth, some argue it could be an acceptable price to restore fiscal responsibility. Yeah, a little pain now is better than a lot of pain later. However, the focus should be on addressing the structural issues in the welfare system and the overall spending. Welfare is not a federal problem. I don't know why we're paying for it. The impact of a government shutdown on financial markets is often cause for concern among investors. While short-term wobbling and uncertainty are expected, historical data shows that market reactions to shutdowns have become increasingly muted. Investors tend to become skittish in uncertain environments, but markets often recover once funding is secured through temporary measures. The larger concern is the persistent fiscal irresponsibility in Washington, eroding economic growth and prosperity. Structural issues, changing demographics, and deflationary pressures continue to weigh on economic prospects. A government shutdown, if it prompts a return to fiscal responsibility, may be viewed as a positive step. However, the core issue remains the need for comprehensive and responsible budgeting practices. I don't think it'll happen. I think that, seriously, no one in charge ever does anything until the house is on fire. So until Washington is crumbling around and they're going to stand around and say, "Oh my God, we got to fix this," and then I imagine most citizens are going to just stand there with their arms folded and be like, "No, you don't get any more of our money. Screw y'all. Deport them to Gitmo for all I care." All right. Last up, this comes from LouRockwell.com. The article is titled Trigger for the Next Financial Implosion, written by Jim Quinn. This is pretty short, so I'm going to read this verbatim. So, all right, let's jump into his article here. The U.S. banking system and likely the global banking system is essentially bankrupt. They won't admit it, and central bankers won't let them admit it. These brilliant Harvard Business School and Wharton-trained financial geniuses thought it was a great idea to load up their institutions with mortgage and treasury bonds when they were paying 0.5%. Now the 10-year treasury is 4.58%. Even an adult like AOC or Pelosi should know that bonds lose value when rates go up. Well, I mean, AOC does have a degree in economics, but we know how she probably got that degree. So here we are with banks, almost $600 billion underwater in their bond holdings, waiting for our next Minsky moment. Those living in a fantasy world of no consequences aren't worried because these banks don't have to realize these losses until they sell. Here's a chart showing all these losses here. All right. After rewatching The Big Short last week, I realized we are about to see history rhyme. There was an interminable period prior to the 2008 financial crash where Wall Street cabal, government bureaucrats, central bankers, rating agencies, home buyers, and stock investors all pretended everything was fine as the toxic fraudulent mortgages began to default because Mexican migrant workers and topless dancers couldn't make the payments on their $500,000 mortgages. The banks actually marked their CDO and CLO weapons of mass financial destruction up in price. They were going to keep on dancing until the music ended. Extend and pretend kept the good times rolling until it didn't. Once the wrong grain of sand falls on the weakest part of the sand pile we call our financial system, the collapse will commence. Once the losses start to mount, the Wall Street banks will be forced to sell in order to generate liquidity. I know it's coming. You know it's coming. They know it's coming. It's just a matter of when. The Fed's balance sheet will double again in a fruitless effort to save the corrupt system once more. We are in the waning years of the fourth turning. This will not be resolved peacefully or by kicking the can down the road once again. We are about to reap what Washington and Wall Street have sown since 2008. It's going to be glorious. I cannot wait. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful day, and I'll talk to you next time. Adios.